Yesterday I spoke about money under laissez-faire. I tried to give you an impression of how some rather sophisticated monetary arrangements can develop without the helping hand of government, and how, in fact, those arrangements tended to produce a degree of monetary stability that is not what is greater than what we associate with modern government-based monetary arrangements. Today, I want to talk about some of the consequences of government intervention in monetary systems. Particularly, I want to talk about the destabilizing consequences of central banking. Now, there are actually many ways in which government interventions can destabilize monetary systems, and I will talk about some others today as well. But the very existence of central banks is itself an important, I think the most important destabilizing form of government intervention, and it's one that isn't often recognized as such. Indeed, most monetary economists take for granted that central banks have a stabilizing effect on monetary systems. I'm going to try to show you why that's not true, and also how economists came to believe the opposite of what's true. We're going to start by talking once again about the Scottish banking system, which, as I noted yesterday, is one example, the best known example. Oops, we've got some corruption on our little picture there. Can we get rid of that before the McPhee company asks us for a donation or something? The Scottish banking system is one of the most well-studied examples of a free banking system. That is, a banking system that did not involve a central bank for some time. It still doesn't. Scotland still doesn't have a central bank today. Instead, for its circulating currency, it relied on a number of competing banks of issue. That number has since been reduced to just 2, and those banks are now subject to very heavy regulations. Indeed, one of them has been nationalized in the recent crisis. The true heyday of free banking in Scotland lasted roughly from the last quarter of the 18th century until the middle of the 19th century. By the way, the reason why Scotland had free banking has to do with what was essentially an accident of politics. The Bank of Scotland was set up not long after the Bank of England in the late 17th century. However, because it was suspected of Jacobin sympathies, the British Parliament allowed a rival Whig bank to be established some years later, the Royal, get it, Bank of Scotland, royal to England, that is, or to the English king. And that opened the floodgates to what became free banking in Scotland. I want to remind you of how competition and currency issue here on the basis of a gold standard disciplined the Scottish banks and produced the era of stability to which I've referred. Scotland at this time is on a gold standard, and the gold pound is the standard unit. It's the same unit used in England. The result of many banks issuing notes is that the notes of each of these banks is treated more or less the way checks have been treated in more recent times. That is, on a biweekly or ultimately a daily basis, items, checks or notes, in those days mostly notes, that banks receive from their rival banks are sent to a central clearing house, like the one depicted here actually in London in the Victorian period, early Victorian period. Those items would be sent for clearing and collection to the rival banks. The simple consequence of this was that any bank that was too generous in its lending and therefore put too many notes into circulation would find itself encountering a net reserve loss at the end of the day once all the settlements were achieved. And of course, having only limited reserves with which to settle this net loss, the bank would be constrained to contract its lending in order to prevent itself from being in default. In other words, as I said yesterday, the banks in a competitive or free banking system like the Scottish one are in a situation rather like that of prisoners in a chain gang. The prisoners can't escape because unless they could perfectly coordinate their actions and therefore escape together, any one of them trying to run away faster than any of the others or trying to run away alone will immediately be pulled back because obviously the fact that they're chained together means that one cannot escape independently of the others. In the same way, any individual Scottish bank that was too aggressive in its lending would be yanked back by its reserve losses. And it's very difficult, practically impossible, for a group of competing banks to so perfectly coordinate their overexpansions as to prevent any one on any particular day from finding itself short of gold or at the risk of being short of gold. In fact, this chain gang type arrangement has some important stabilizing properties other than the obvious one of preventing gross overexpansion while allowing banks to expand when it's warranted, I should say. If you have a public that wants to accumulate bank money, hold on to bank notes, or accumulate bank deposits, then to that extent, the banks whose liabilities are in greater demand can afford to issue more of them because this desire of people to hold more of them means that the extra issues don't flow into the clearinghouse, don't get sent back for collection, and so don't add to the total demand for settlement reserves that the bank would otherwise confront. The result of this situation is an equilibrium in spending that's depicted in this diagram, and I promise you it's the only diagram in the talk, but I can't resist. That vertical line, let that be this available supply of gold reserves for the whole banking system. The curved line shows the demand for reserves by the banks collectively, where the vertical axis is the total amount being spent in any given period, say between clearings. So that's the money stock, the outstanding stock of Scottish bank money, for example, and it's multiplied times its velocity, which determines how rapidly people spend money that they've got. Well, the demand for reserves rises not quite proportionately with total spending, as more spending generates more need for reserves for banks to avoid net reserve losses or cover themselves against the probability of random withdrawals that might hurt them. There's economies of scale in reserve holding. That's why the curve is a curve rather than a 45-degree line, or a straight line, rather. And there's a unique equilibrium, and what that means is that if people want to hold more money, if V goes down, banks can issue more to return to that equilibrium. If V goes up, they have to issue less to get on that equilibrium. So spending is automatically kept stable for any given quantity of reserves. That's a very nice property. Stability of spending recently, for example, might have helped us to avoid going from a mere financial crisis to a recession in 2008 and 2009. But our central banking system didn't manage to avoid rapid decline in spending as a free banking system might. I'll show you that later on. Okay, what happens when we set up a monopoly, as England did in establishing the Bank of England in 1694? Well, since I'm about to argue that such monopolies are highly destabilizing, I'd better explain to you why any country would establish a monopoly in light of that consequence. The simple reason in those days, and a motivation for many central banks created later on, was that central banks have a fiscal advantage for governments. In return for their monopoly privileges, they can be required by governments to extend credit to those governments and accommodate the government's fiscal needs, especially in war. The Bank of England indeed was set up expressly for that purpose. No thought was given to monetary stability. Monetary stability was not something anyone was thinking about at the time. They certainly didn't believe they were setting up an institution that would contribute to such stability, even if they didn't realize how much it would contribute to instability. Here you see some part of the act that created the Bank of England. It was called a Tonnage Act, which is essentially a kind of revenue act. And it was an act for granting to their majesties several rates and duties for securing certain recompenses and advantages, blah, 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 towards carrying on of the war against France. Well, there you have it. So that was the real motivation behind the granting of the Bank of England's charter and the attachment to that charter of certain monopoly privileges. I should say the bank didn't have an outright monopoly of currency for all of England at first, but it would slowly acquire one, and its other privileges, including a partial monopoly of currency in the London area, were sufficient to give it the great lending power that made it worthwhile to establish it for fiscal reasons. In fact, the perceived lending power or value of the bank's monopoly based on that lending power was such that its shares were fully subscribed at once, and the deal was that the full value of that subscription went right to the government. So the government basically is selling a monopoly, taking the proceeds of the sale of the shares, and going to war with France with them. That's the setup. All right, how does that change things? Well, if a bank in a competitive or free system like the Scottish system is like a member of a chain gang, a monopoly Bank of England like a bank of issue like the Bank of England is like a Pied Piper of credit. It's in a position not only to lend without facing the repercussions of reserve losses at a clearinghouse, but to lend and inspire remaining less privileged banks to lend along with it, that is, to follow it. The best way I can explain that is to return to my little diagram once more. I said I wouldn't have any more, but I didn't say we wouldn't have to put up with this one a little longer. Okay. Now, in this diagram, as I originally explained it, the vertical line is the stock of reserves, but that consists only of the gold available to the banks. There is no other sort of reserve money. The ultimate reserves of the Scottish system consist of the gold that each bank has on hand. Not so when you create a monopoly bank. Why? Because now all the other banks depend on the monopoly bank as their source for paper currency. Now, we think about paper currency today often as being inferior to gold, but for many people, the transactions advantages of paper made it highly desirable so long as it was trusted as a close substitute. Consequently, banks that didn't have the privilege to issue currency that the central bank or Bank of England had would treat the Bank of England's IOUs, especially its notes, but also any deposit credits they might have with it, as their own reserves, as something they would hold on to and reissue to their customers. So the immediate stock of reserves ceases to consist solely of the gold available in the banks and now consists of the outstanding quantity of IOUs issued by the privileged central bank. So now that vertical line isn't gold, it's how big the balance sheet of the Bank of England is. And if the bank expands, that line moves to the right, and the total amount of spending can go up because all the banks now have more reserves and you can have a higher spending equilibrium. Does that make sense? Good. So that's the sense in which the central bank now is the Pied Piper. If it expands, the whole system expands. If it contracts, though, the whole system has to contract. And by the way, such is the preference for the convenient reserve medium supplied by the central bank to gold that the tendency is for the less privileged banks not to even hold much gold, but to send all of the gold to the central bank in exchange for its IOUs. Now, what that means, of course, is that the central bank can expand without facing any immediate repercussion. The only immediate consequence is that it encourages the whole system to expand. But of course, that has macroeconomic implications, and those implications, plus the long-run constraint that they would put into effect, were best described at first by the great Scottish philosopher David Hume with his notion of the price-specie flow mechanism. Now, the price-specie flow mechanism is an international equilibrating mechanism under a gold standard when many countries or several countries are on such a standard. It's a source of constraint to expansion in any one country when the expansion isn't going on elsewhere in the world. In contrast, in the Scottish system, each bank is, in a sense, constraining every other bank internally. So you have an internal source of limitation on expansion. Not so in the monopoly system. So let's suppose we take a case where the Bank of England is going to lead all of the banks in a general expansion of credit. What happens? Well, let's start with international equilibrium. What does that require? It requires that the general level of prices for comparable goods and services in the one country we're interested in, here, England, not be dramatically different from the level in terms of the same unit in gold of prices of comparable goods in, say, France. Let's assume we're in that situation at first. The price level can vary around this state of perfect purchasing power parity within small limits equal to the costs of transportation from one country to another. But if prices in England rise sufficiently high, then international equilibrium will be violated. And that violation consists of the fact that now the same amount of gold can actually buy a lot more in France than it can in England. Which means at some point, people realizing this will start importing things from France that they normally would have bought in England. And now, sure enough, there will be a check, a constraint on expansion in England, consisting of the drain of gold from the English economy to the French economy, and which bank is going to feel that drain? Well, the central bank, because that's where the gold is. So the Pied Piper the Pied Piper of a central bank can take an economy out of international gold standard equilibrium, which would not have easily been possible if there had been no central bank that was leading all banks in a common erroneous direction. Now, okay, so now gold is leaving. What's so bad about that? What's bad is now we have a corrective, but it's a long-run corrective. And the bank, having generated excess credit, caused prices to rise, now is suddenly going to contract to save itself from running out of reserves. And so a system that's allowed on too long a leash to go way out of international equilibrium is, by virtue of this price-specie flow mechanism, suddenly, dramatically, violently yanked back. As the central bank, having overdone it, perhaps at the behest of a government in need of funds, now needs to rescue itself. And remember, this is a private institution. It has no concern about the consequences of its policies for the economy as a whole. This mechanism caused crisis after crisis in the English economy, crises that were occurring there while Scotland was crisis-free. And in the English crises, marked by external losses of specie as well as panic that led to internal withdrawals, would involve the failures of hundreds, sometimes thousands, of private firms. It was the classic gold standard boom-bust cycle, and it was a consequence of central banking. And the proof is that non-central banking systems didn't experience the same crises. Oddly enough, this phenomenon of central bank-driven crises helped, ironically, to give rise to the notion that central banks are a good thing and that every country should have one. How did this happen? It happened because of a fellow who himself was totally innocent, named Walter Bagehot. Bagehot's name is no doubt familiar to many of you because there's a column in The Economist by that name. That's because he was the most famous, the second editor of The Economist magazine. He wrote a book called Lombard Street, 1873. Very important book. Now, what most economists will tell you about Lombard Street, not having actually read it, of course, is that in Lombard Street, Bagehot develops the classical doctrine of the lender of last resort, of how a central bank should act as a lender of last resort. He advised there that in the face of specie drains, rather than tighten credit and plunge the whole economy into a credit crunch and crisis, a central bank has a duty, a monopoly bank of issue has a duty, to keep credit flowing, albeit at high rates of interest, so as to attract gold from abroad, but keep credit flowing, acting as a lender of last resort when no one else is in a position to lend. Now, Bagehot was very explicit about what point he was making here. He wasn't saying that a central bank is a good idea because it can be a lender of last resort. He said, central banks are a bad idea, but if you're stuck with them, here's how you want them to act so as to do as little damage as possible. He's very clear about the fact that it would be better not to have such a privileged institution at all. That it would be better to have what he called a natural system, with banks holding their own gold reserves. Here is a quote from the end of the book. He makes the point clearly enough elsewhere as well. "I have tediously insisted," Bagehot says, "that the natural system of banking, that of many banks keeping their own cash reserve with a penalty of failure before them if they neglect it by overissuing, that's the natural system. I have shown that our system," meaning England's, "is that of a single bank keeping the whole reserve under no effectual penalty of failure, at least in the short run. Yet," he said, "I've proposed to retain that system and preserve it, try to keep it going by having the central bank act in a publicly spirited way by serving as a lender of last resort." Well, why am I saying this? He realizes he's being perverse, right? He can only reply, quote, "that I propose to retain this system because I'm quite sure that it is of no manner of use proposing to alter it. You might as well or better try to alter the English monarchy and substitute a republic as to alter the present constitution of the English money market." He felt that it was politically impossible at that point to get rid of the Bank of England. The irony of his statement is, today we can easily enough imagine people wanting to do away with the British monarchy, but not with the Bank of England. This is how quickly institutions once in place become sacrosanct. But of course, the effect of the misreading of Bagehot's book was just to reinforce the sacrosanctity of central banks in the eyes of experts who read Bagehot or understood him without reading him as actually positively recommending that countries have lenders of last resort. That's part of the crazy history of central banking. By the way, there were only 19 central banks in the whole world still at the eve of World War I. Their number doubled in the interwar years thanks to the assiduous marketing of them, crusading for them, backed by international agencies tying loan agreements to their existence. It was a campaign conducted by two central bankers chiefly, Benjamin Strong from the U.S. and William Montague from the Bank of England. They went around, held conferences recommending that that every country have a central bank, get this, to help get back to the gold standard. And agencies, starting with the League of Nations, but later the IMF, would tie emergency and other development lending to conditions including, you have to have a central bank if you want this support. What about the United States? Now, I've told you that central banking is a destabilizing factor, but no doubt you've heard the claim that we didn't have central banking before the Fed, and we needed the Fed to stabilize what was already an unstable banking system. Well, there's some truth to it, but it's not, it doesn't amount to a true claim to the effect that central banks are stabilizing than destabilizing. The truth is that central banks aren't the only devices capable of destabilizing what might otherwise be a stable monetary and banking system. That's true. And it's true that the U.S. system without a central bank was highly unstable. but it was unstable because of other interventions. Finally, the Federal Reserve didn't fix things. It proved to be a perfectly inadequate solution to the pre-Fed instability problem, and there would have been a free banking solution. There was a free banking solution that, in fact, would have worked much better, and I can say that with some confidence for reasons I hope will become clear. To revise the record on the U.S. experience, let's first toss out a couple myths. First of all, we never had unregulated banking in the United States. Banks have always been subject to more or less deleterious regulations in the U.S. It was never a free-for-all. Second, to the extent that there were bad results in our banking system, whether it was unscrupulous banks or have losses to note holders, the results could easily be traced and have been traced by economic historians to government interference. These maps give you some idea of how tough it was to have a bank at all in the U.S. You had a charter system up until 1837, whereby the establishment of a bank, each single bank required an act of the legislature of the state or territory in question. Some legislative bodies were more generous, as those of New York and Massachusetts. As you got south or west, the generosity declined until you had many places that had only one bank, so they had monopolies, or they wouldn't allow banking at all, as was true for a long period in the West. By the way, the biggest problems in banking and currency weren't in the areas that had the most banks, but within those that had the fewest. And that's perfectly understandable. If you were somebody living in one of the states or territories where banking was entirely outlawed and you needed some banknotes, you had no choice but to rely on banknotes that purportedly came from far away. You might not be a good judge of whether those were legitimate or not. Every swindler in the country who was counterfeiting banknotes knew perfectly well that the market for those notes was in the places that had prohibited their own banks. And so some of the worst episodes of fraud and forging and counterfeiting were exploiting the prohibition of legitimate banks in big swaths of the country. After 1837, or starting that year, a new system for chartering banks was established in some states. I shouldn't say for chartering, but for more or less incorporating banks according to a uniform procedure that wouldn't require a special legislative vote and all the corruption that typically entailed. As you can see from the red dots, these new so-called free banking laws allowed more banks to get in the system, eventually a substantial number, but still they were very restrictive. Despite the name, free banking laws in the United States didn't allow true free banking along Scottish-type lines where there was hardly any heavy-handed regulation. On the contrary, free banking laws uniformly prevented banks from having branches. One of the big sources of weaknesses throughout the history of U.S. banking until relatively recent times has been the lack of branch banking, which, by undermining banks' ability to diversify their assets and liabilities, has been one of the most potent causes of bank failures. I'll elaborate on that point later on. So, free banking reinforces restrictions on branching, not allowing any branches for any banks. Second, free banking laws required banks chartered under them to back their notes fully by specified assets. Banks weren't free to choose the investments that they financed when they issued notes, which were the most important source of bank finance back in the 19th century. Instead, these free banks had to buy the specific assets that the legislatures, the laws said they had to buy. And guess what? Often those assets were junk, or turned out to be. Ostensibly, the idea was the bank can't issue notes till it buys assets which are lodged with the state banking authority and kept safely so that if the bank fails, they can be sold to redeem the notes. It's a good idea if the assets are good. But if they happen to consist of, say, the bonds of that very state government, which happens to be, say, fiscally irresponsible, then it could end up that the bank fails precisely because the bonds it was forced to acquire lost value. Guess what was the main cause of free banking failures, according to economic historians, U.S. free banking failures? It was precisely the depreciation of mandatory note collateral in the free banking systems, regulation. A big change came with the Civil War. As with other such wars in the past, the Civil War generated momentum for monetary reform. But why? Why should wars get people thinking about changing their monetary systems? Is it because they have a sudden urge to improve things? No. It's because the governments become desperate for revenue and look at their monetary systems as giant piggy banks to be restructured in a way that will generate credit for their wartime expenses. Such was the case with the establishment of the national banking system through the National Banking Act and subsequent National Currency Act of 1863 and 1864. These laws allowed banks to have federal charters, something no one had ever seen since the demise of the Second Bank of the United States in 1836. Now anyone could have a federal charter if they subscribed to the requirements of the law, which included the stipulation, like the old state free banking laws, that certain assets had to be used to back the bonds of the new banks in question. What assets do you suppose they were? This was union legislation, folks. Whose bonds? Federal government bonds, union bonds. Duh. This is to pay for the war. This isn't about stability or safety. If the union loses, the note holders lose, right? The banks fail. Well, the union didn't lose, as we know, and the story of the Confederacy, which did, isn't really part of the overall story of the development of the modern system. But in any event, this was a fiscal arrangement. It was a wartime arrangement. Now, as it happens, the union's finances, or the federal government's finances after the war, were such that these bonds not only kept their value, so the banks didn't fail because they declined in value. That problem was avoided. That's the good news. The bad news is that the federal government ran surpluses quite often in the 19th century. That's an obscure concept, so let me explain. They raised more tax revenue than they spent. Yeah, I know. Sounds strange, but it used to happen. In any event, what happened with these surpluses is they used them to retire some of the outstanding debt, including debt contracted in the war, but more importantly, including debt consisting of bonds that were eligible as backing for national banknotes. So those bonds started to appreciate. Their market value went higher and higher and higher relative to their par or face value. What's wrong with that? What's wrong with that is that the amount of notes a national bank could issue was equal to 90% of the nominal value of the bonds it had on hand, which meant that if bonds cost more than, say, $100, a bank might be finding itself paying $105 for the collateral or security it needed to issue $90 worth of notes. The higher the market value of the bonds, the harder they are to come by, except at high prices, the harder and less profitable it is to issue currency. Here's an interesting chart. The top line shows what's happening to the supply of national banknotes, the main source of paper currency other than greenbacks, which were still around from the Civil War, for the last part of the 19th century and early 20th century before the Fed. Oh, by the way, what happened to state banks that were used to issue notes? Even though there were some fine state banking systems, I mentioned the bad ones, but there were also good ones, state banks were all forced out of the currency business during the Civil War by a prohibitive 10% tax passed in 1866, so that's where all the state bank money went. Some economic historians carelessly write that national banknotes were so popular that they took over and the state banks gave up. That's not true at all. The reason the tax was passed was precisely because the national bank charters weren't as popular as they were meant to be. So, well, if we can't use a carrot to get state banks to switch, we can always use a stick. Okay. The greenback supply is absolutely fixed by legislation, so it can't fluctuate. Look what's happening in the supply of national banknotes after 1880. This is a growing economy, right? What do you think is happening in a growing economy to the demand for currency? It's a rapidly growing economy, a rapidly growing population. The demand for currency, you would think, is going up, but the supply is going down. In 1890, there's less than half as much currency available as there is in 1880. We have here two freight trains, one of demand and one of supply, coming at each other on opposite tracks, leading to severe currency shortages. Now, actually, the bigger problem wasn't the long-run contraction of supply, it was the short-run inflexibility. As you can see, that line doesn't move around very much, but the demand for currency fluctuated to a large extent seasonally. Every autumn, there'd be a big spike in currency demand as farmers needed to pay their itinerant workers who needed to be paid cash. But the system, as set up under the national banking laws, couldn't allow banks to issue notes on a merely temporary basis. Well, that would mean buying those expensive bonds to put out notes for a season that would then come back and sit around. Now, that's truly unprofitable. So, no seasonal flexibility. Every autumn, interest rates spike in the United States with the harvest season as money gets tight. After all, if a farmer can't get national banknotes from a bank, he'll ask for his gold or legal tender greenbacks, and that means impinging on the bank's reserves, which forces the system to contract credit. What's worse is, under the national banking laws, a bank in the countryside, a rural bank, can count as reserves its deposit credits at a Midwestern city correspondent bank. And that bank can count as reserves its credits at a New York correspondent bank, which means that when there's high demand for currency in the countryside, withdrawals of reserves are magnified, and they ultimately are felt 3 times as strong in New York. So you could occasionally have big financial crises in New York, currency shortages, currency panics, 1884, 1893, 1907, they get worse and worse. There was some relaxation of the currency supply after 1900, but the economy is still growing very quickly. What to do? Well, these panics are what proximately lead to the establishment of the Fed, right? But before we consider that solution, let's look at that other line. What's that? What's also a currency supply or quantity chart? And it's rising, not dramatically, but fairly steadily. It's got a nice smooth trend. And it's got these lovely sawtooth type movements, just like the seasonal demand for currency to move the crops. Oh, it's the Canadian banknote supply. Well, it's obvious what's happening here, folks. Canada has a central bank that's running everything and managing the supply of money scientifically. Right? Oh, Canada has no currency crises. In fact, during the U.S. crises, extra Canadian notes flow over the border to help the U.S. public deal with its need for currency. The problem with the central bank hypothesis, unfortunately, is Canada didn't have a central bank either. It didn't set up one until after we did, in 1935. What Canada has is a system very similar to Scotland's, with multiple banks of issue. Oops, lost my video. Okay. With multiple banks of issue competing, the supply of currency is determined strictly by competitive market forces, profit-seeking banks in rivalry with each other, settling accounts on a regular basis. That's a picture of New York in the panic of 1907. Here are some Canadian banknotes. Why didn't we do what Canada did? It had a solution facing us right in front of us, right? Newspapers reported about it. Today everyone's forgotten, but back then everyone knew. It was notorious. Well, it was partly the fault of this fellow. You know him as the guy who wanted to kill the gold standard. He didn't succeed, but William Jennings Bryan did kill off any proposal for liberating U.S. banks, for allowing them to issue their own notes free of binding regulations like those that had been put in place in the Civil War. He blocked all the reforms, there were a dozen of them or more, to try to create Canadian-style asset currency in the U.S. And that forced the solution of a central bank, the signing of the Federal Reserve Act. It did not work as well as the Canadian plan. In fact, it generated a crisis far worse than any crisis that had been seen under the previous unstable national banking system. The Federal Reserve proved to be a very poor solution to the problem of financial instability. I won't go into the gory details because of time. I'm almost done. Many banks failed, by the way, partly because so many were unit banks that were under-diversified. Most of the banks that failed were small rural banks. Money supply collapsed with it. The Fed did not offset that collapse, and as a result, you got a dramatic decline in spending and output. Prices eventually fell as well. Nor did the Fed contribute to the subsequent recovery, contrary to what people might think. The whole recovery in the 1930s, such as it was based entirely on increases in the gold stock. Part of that was the devaluation, which increased the nominal value of available gold. But starting in 1933, gold poured in from Europe, partly in response to Hitler's rise to power. The bottom line shows what the Fed was doing to boost the money supply and make up for the collapse that had happened. Nothing. Here's how many banks failed in Canada. During 1930 to 1933, there was still no central bank in Canada, folks. Its money supply collapsed because of gold losses. Canada couldn't possibly not suffer from the Great Depression when its main trading partner was going down the drain. But Canada's money supply only fell 13%. Ours fell 33%. Deposit insurance ultimately stopped the failure of banks in the United States, but it was not an ideal remedy. It was a poor substitute for structural reform and free banking. It caused capital ratios to decline, ultimately leading to a situation where we needed more. And it was the first of many steps that would create the new problem in our U.S. system. Now that we do allow branch banking at last, we started really allowing it in the 90s, the new problem isn't small banks, it's big banks. Banks that are too big because of too big to fail and the implicit guarantee that makes being big a good deal. But it also means that banks have an incentive when they're big to take excessive risk, and we know what that means. I'm running out of time, folks. I'm going to quickly sum up what's happened since the Depression. Back in 1999, Christina Romer, who's hardly a free market Austrian gold bug, she was the first president of the Obama's Council of Economic Advisors, but she's a very good economic historian, wrote this passage we see: the average length of recessions is actually a month longer in the post-World War II era than in the pre-World War I era. There's also no obvious change in the distribution of the length of recessions between pre-war and post-war. In other words, the Fed still hasn't made anything better, even if you set aside what was happening between the wars. That's 1999. How do you think the Fed's record looks since? I wish I had time to talk about the subprime crisis. I'll simply say that it was a perfect storm of bad regulatory interventions. The Fed is part of the story. The fact that we don't have a gold standard doesn't mean central banks can't cause booms and busts anymore. The mechanism is somewhat different. Now, back then, overexpansion meant you triggered gold losses abroad and you had to pay the piper. Now it means asset prices rise to unsustainable level and then they pop. It's still the same problem, underlying problem, of central banks being able to expand beyond the bounds consistent with underlying savings. John Taylor argues that it was such excessive expansion, as reflected in an artificially low interest rate held there after the 2001 dot-com crash, that was, to some important extent, what fueled the subprime credit boom. This chart shows the difference between the Fed's actual interest rate, which stayed down for a very long time in what was, in real terms, negative territory, in fact, versus where he thinks it should have gone to avoid contributing to a boom. Here's his counterfactual of how much smaller the boom might have been. I believe that a policy different than the one that Taylor is envisioning here as a counterfactual policy would have done even better than that. course, the Fed wasn't alone, but it was one of many agencies, government agencies and regulatory arrangements that contributed to the subprime crisis. Yet another crisis, the story of which cannot possibly be told without appealing to the role of misguided government regulations. John Allison, who I think may be here, his book is excellent on this. You can't ask for a better account of the many factors that contributed to this crisis. Here's Greenspan saying that he took a calculated risk. Thanks, Alan. Oh, well, I'm going to stop now because I want to leave some time for questions. We can talk more about the subprime crisis and all that, but you may have other questions as well. So let me call a stop to the proper discussion now and open up the floor for your questions. Thank you very much. Yes, sir.
What happened with Canada post that chart?
Post
the chart time when they...
Well, so Canada had one bank failure in about 100 years, maybe more. In 1923, the Home Bank, I believe that was the name, Home something bank, failed. And it was a big deal for a Canadian bank to fail. Usually the banks dealt with failures or with insolvencies by having other banks swallow up banks that were about to become insolvent, and it was quite a seamless operation. Nationwide branch banking makes that kind of resolution very easy compared to the case in the U.S. where we didn't have branch banking for a long time. So you had that one crisis marring the Canadian experience. Other than that, though, as we can see, Canada's record still was far superior to the U.S. right into the 1930s. That, of course, begs the question, why? Why did Canada establish a central bank, the Bank of Canada, in 1935? Good question. An article has been written about this by Angela Reddish and Michael Bordeaux. It's called, Why was the Bank of Canada established in 1935? Now, economic historians don't write articles with titles like that unless it's a good question, meaning it wasn't something obviously needed. They point out that, in fact, what happened was populist forces, not unlike the ones behind Bryan's campaign in the United States some decades earlier, were pining for unlimited or generous issues of paper money. Just as we had our greenbackers, they had their Major Douglas followers who wanted the government to issue paper money and plenty of it. To head off that populist movement, the Bank of Canada was created as a sort of a sop or compromise. Basically, the idea was the populists could hope that the Bank of Canada would inflate, the conservatives could hope they could keep it from inflating. And that's what made it politically a palatable solution. But, of course, economically, it was far inferior to having a competitive or free banking system.
Thank you for the fascinating history. I'm curious why, you said that U.S. never had free banking. What was happening? Why did Canada have a more free banking and not the U.S.?
This is also a very good question, and it has to do with the structure of American federalism. With American federalism, unfortunately, banking was not considered a form of commerce. Now, you all know how the Commerce Clause was designed to protect most forms of trade, exchange, from interference by the state governments, so that there would be no tariffs erected along state lines. But banking was not considered commerce for the purpose of that clause. And that meant that state governments could prevent banks from other states from branching into their territories and otherwise doing business there. So this made each state a kind of self-contained silo beyond the borders of which its banks couldn't branch. But even within states, the tendency was to hearken back to the old times when a bank was looked upon by many people as, oh, the Bank of England's a bank, right? A bank is a privileged thing. The idea of banking and monopoly in the minds of many went hand in hand. So if you were a banker and you got yourself a charter, you, first of all, weren't shocked by the fact that it didn't allow you to have branches, but you also were determined to fight tooth and nail against any rival banks being set up. And so that's what happened in the United States. So we had this decentralized, divided, fragmented banking system that eventually supported thousands, 36,000 different banks. Canada never had more than a few dozen of any importance, but that's because their style of federalism put the power for granting bank charters in the hands of the central government, and for once, I'm afraid I must say this was a good thing, at least to that extent, because these banks now had authority to do business anywhere in the country. No particular region or state in Canada, none of the territories could individually prevent banks from entering into them. And that created a nice diversified system where competition ultimately limited the numbers of banks. Well, more than that, the Canadian government was pretty strict in chartering banks. In a truly free system, there might have been more banks chartered than the number we saw in Canada. Yes, sir.
Yeah, thank you very much for a good two talks. I missed you on the, shall we say, the fiscal meeting that we had yesterday. I wish you'd been on that in that group. So I'll ask you the same question. Are these terrible things that these banks do, these central banks do, are going to lead to a collapse in fiat money? And if not, why not?
Well, the answer is, in some cases, yes, it's a good bet. There are, of course, as many fiat monies as there are independent central banks today, and if the past is any guide at all, some of them are going to go kerplop, like the Zimbabwean dollar, for example. So, sure, some of them will. But and the other thing you can predict is that they'll all depreciate over time. But whether depreciation adds up to destruction of a currency is a matter of the rate of depreciation. A currency can depreciate forever if it depreciates at a relatively modest rate. There's no limit. But, of course, if the control of the supply gets if they lose control of the supply of one of these currencies, as Zimbabwe and many other states have done, then, of course, the depreciation does add up to the demonetization of the economy, to the worthlessness of the money in question. So the answer is that some of our fiat monies could conceivably go on forever. It's doubtful that they all will.
Yeah, so on the question of William Jennings Bryan, so what was his motivation? Because it seemed like the thing that was going on, which is this constriction of currency, at the beginning was actually directly harmful to his populist constituency. So why was he essentially say, maintain that system? Just, I'll change it to make it the opposite, or something different?
No, he didn't want to change it to make it the opposite. So Bryan's attitude, and that of the populists who followed him, is that currency should be something supplied democratically, which meant by government, and that all people should have a say about how much of it is supplied. And the idea is that the farmers can vote for more and maybe get more. So he wanted a currency that could be politically, the supply of which was capable of political determination. And that, at that time, meant more greenbacks, more of the stuff that had been issued during the Civil War, and that's why you had a greenback party and all that. So that's what he wanted. Now, on the other hand, he was completely opposed to having private banks in the business of determining the quantity of currency because he felt that they were too conservative and wouldn't issue enough of the stuff. He was very reluctant for that reason to support the Federal Reserve Act, and he nearly scuttled it because the Fed was founded as a nominally private bank, but ultimately Wilson was able to persuade him, making him the Secretary of State, didn't hurt, to go along with this, what we might call compromise legislation. So that's basically the story. So it wasn't that Bryan didn't want more currency, but he wanted it to be more of the right sort of currency, so there could be not just a little more, but a lot.
So you've talked about the Scottish banking system and the Canadian banking system at these particular points in history as being much more free than what was going on in England at the time, in the United States at the time. Could you comment on how these banking systems worked, compare their structures, and discuss whether they would be a good model for something we could do in the United States in the future to move toward a more free system?
Well, that's a great question, too. The Canadian and Scottish systems were actually fairly similar, so it's possible to describe them, at least loosely, in the same terms. That's not a coincidence, by the way. The Scottish Canadian, or Scots, were primarily responsible for the creation of the Canadian banking system, and so they designed it along Scottish lines. So in both of these systems, you had one important departure from true freedom, which was that the government would only charter a limited number of banks. It had the characteristics of an oligopoly. Those studies have shown that the monopoly power of these oligopolies wasn't all that great. How many banks would have been established instead with freedom of entry, which would have been part of a truly free system? We don't know how many more, but probably not that many more. In the systems, the banks all had more or less equal privileges. In Scotland, there were a couple banks that were limited liability companies and many more that were unlimited, so they didn't all have exactly the same privileges. But they had equal rights to issue notes, and that was the crucial thing in that it gave every bank the incentive to treat its rival bank's notes not as a valuable reserve asset to hold on to and reuse, but as something to be returned like a check for payment. And that was the key source of discipline in these competitive note issue systems. Now, as for how you could replicate something like that today, I'm afraid it's not so simple. You see, in those days, the reserve money was gold or perhaps silver, depending on how far back you go. So you had a standard money that was supplied independently of the existence of any bank or financial institution and independently of the existence of a central bank. It's easy to conceive of a free banking system with a metallic or commodity standard of some kind. Today, what would it mean to have free banking on a dollar standard? Well, of course, the dollar standard owes its existence today as a fiat standard entirely to the Federal Reserve System. It is something produced by the Fed, and its supply, therefore, is regulated by the Fed. We could imagine banks being able to issue dollar-denominated notes of their own that are IOUs payable in Federal Reserve notes. And if the banks could do that and were free in other respects, we'd have a free banking system, but we'd have one built on the foundation of a fiat dollar, which is, of course, so far, a rotten foundation. So the system might be a good system, but if the ultimate standard money is itself badly managed, well, the free banks cannot make up for that. Now, that means that if we want to continue with a dollar standard, we have to do something to reform the standard money itself. Free banking alone doesn't do that. We need standard money reform or reserve money reform or dollar reform, whatever you want to call it. That could take many forms. One possibility, of course, is to make Federal Reserve notes themselves claims against gold. There are arguments to be made for trying to do that. There are also arguments as to why it's probably not going to be feasible. I've made some of the latter arguments. We could subject the quantity of the fiat money to a strict rule, and there are arguments that have been made for doing that. But if we want to not have to have a transition to a completely new standard money that has nothing to do with the dollars we're presently holding and using, if we want to avoid that, we must tame and manage and reform the dollar and put it on some kind of rule of law or rule-bound basis instead of the discretionary basis that exists today. Then you can build a free banking system on the reformed dollar and expect it to be capable of doing all that such a system might be capable of doing.
So in a privatized, where you have privatized currency, don't you have to only create that many money coins or paper currency as the value generated in the economy? And how does that look like? How do you balance that in a free banking system?
Well, sometimes it's a very popular view that what you want is a money supply that is somehow linked to the available supply of goods in the economy. There was an economist who I really like named Dennis Robertson, who was a colleague of Keynes and should have been more famous than Keynes. He was by far the better of the two economists. but Keynes was the better, what's that? Keynes was had better marketing. Robertson once made a quip about the idea that every batch of goods should be born into the world with a little bundle of banknotes tied on it, with a blue or a pink ribbon. Yeah, depending on the goods. Well, that's easier. In France, goods have genders, right? So, for example. But really what should determine how much bank money is put out is not the available goods in the economy, but the quantity of savings that's going on, right? So here's what your ideal banking system does. We save in all kinds of ways, but one way we save is by holding on to bank-issued IOUs, bank money we'll call it, for our purposes. And the idea is if people refrain from consuming in order to accumulate these particular IOUs of banks, then the banking system's job is to see to it that we can all accumulate as many as we want to. And the way it does that is by supplying more IOUs to the exact extent to which we are willing to hold on to them rather than spend them, which amounts to lending in coordination with our savings. So we hold on to more, the banks put more out. We stop holding on and start spending, the banks start taking them back. That's what an ideal system does, and that's more or less what the free banking is doing when it stabilized that spending flow, because you're making up for savings by introducing loans that add to spending, but you're also contracting loans when people save less. That's the real ideal of proper money supply behavior. And that avoids asset bubbles, it avoids lots of problems.
I'll make this as a follow-up question.
Oh.
I believe you're writing a book, so what's the title or content? Can you talk about that?
Am I writing a book?
Yeah. I thought you were...
Somebody told you I was writing a book? I am writing a book, sort of. I have a book that I'm writing in my head and have been working on for some years up there, called The Little Fed Book, Our Crummy Money and How It Got That Way. And you have some idea of the kind of stuff that's going to be in it.
Thank you for your talks.
welcome.
As financial transactions become more and more electronic, it strikes me that the Fed is sitting on and really all central banks are sitting on a gigantic data warehouse via their automated clearing networks and so forth. And I'm wondering if you have any thought about how that might change either the influence or the operations of central banks going forward.
Oh, goodness. That's a tricky one. I'm not sure I know the answer. I mean, they've moved everything now pretty much to an electronic basis. And, we still use paper checks and all that, but they're kind of dinosaurs. And those checks nowadays never actually get sent back to their banks. They get images taken of them, and everything is done electronically, as you know. But I'm not sure that this switch from what we might call analog-based banking to digital or electronic in clearing and settlement, I'm not sure what the implications of that are. I'm sure there are important implications regarding security and things like that. I'm not the right person to try to spell those out, I'm afraid. But as for the implications for the overall way the monetary system works or what the central bank is capable of doing or not capable of doing, I can't think of any major consequences that would stem from this change. I would like to see a world where central banks no longer issue currency, but of course I'd like that to be a world where the private sector is allowed to issue whatever currency is needed, in case we do want some. The private banking system is basically boils down to this. An economy has something that's its basic money. Bankers are in the business of trying to convince you to give them that stuff and take their IOUs so they can lend. And it's a wonderful idea. Adam Smith talks about it so eloquently, as I mentioned in my other lecture, because what this does is to take the savings that are bound to be, as it were, held in the form of money in an economy where money is the medium of exchange, and allows that savings to be held as money, but in a form of money that's IOUs, so that the savings is also invested. which is not the case if you have an economy where, say, gold or some commodity is the only kind of money around. And as much as by the way, I don't think going back to a gold standard is very easy or very likely, but please don't misunderstand. We'll never have a system in all likelihood that's better than the old gold standard of the pre-war era, even as much as that system was corrupted by central banks and other kinds of legislative interference. It was pretty darn good, and any economist who claims otherwise doesn't know his monetary history. But still, part of the success of that system consisted of the fact that people trusted many banks to supply good IOUs as substitutes for gold, and so didn't need that much actual gold. And that meant that economic development was more rapid than it would have been in a world where gold itself was the only medium of exchange. The best monetary systems are ones where banks are a big part of what's going on. And that's why I hate all this talk these days. There's always been such talk, but there's more of it lately since the crisis. Talk about how we should just get rid of banks or make them hold 100% reserves or make them hold capital instead of debt, as if a bank could finance itself with capital like a steel plant and still be a bank. This is very bad, and it's based on a failure of people to appreciate the fact that if you don't screw up banking systems with regulations, they're very good things for society to have.
So I know I've read a few papers from the Fed, and you had Christina Romer's quote up there. So clearly all of this stuff you're talking about, in a sense, is known to some extent by people in the Fed. To some groups, so what is their thought on that? Like, they look at Bank of England and Scotland, they're just like, yep, okay, and just ignore it? Or do they have a counter-argument to everything you say in some form or another?
That's another good one. They mostly ignore it. I wrote a paper not long ago with two colleagues called "Has the Fed Been a Failure?" And we had all the elaborate statistics, everything, comparing on every criterion you could think reasonable, the performance of the post-Fed system with the pre-Fed system. And we were very careful to say, look, we don't pretend that this is a straight-out comparison, that everything that's different since 1914 can be attributed to the Fed. So we talked about some other factors that might have come into play and argued that the most obvious ones should, if anything, have made things more stable rather than less. Otherwise, that paper showed that things don't look any better at all since the Fed's establishment. And I must say, it's been totally ignored. And the few times that people do refer to it in discussions or otherwise, they misrepresent what's in there. I've had many conversations with economists who talk to me about the papers as if they were guessing what we said rather than having read it. But part of this is part of the big psychology of the way economists are today. I'm afraid that many of my erstwhile free market friends in the economics community don't want to go that extra distance of embracing free banking because they like to be perceived as scientists and objective. And for them, being objective means that you compromise a little bit with the truth so as not to appear too radical or uncompromising. Well, you know, if the truth is that in banking, government stinks just as it does in a lot of other industries, you should have an obligation to say so. And I tell you, this is a big problem. I know people who will tell you, with respect to any regulation, is that bad? Is it bad that banks can't branch? Yes. Is it bad that we have moral hazard problems stemming from insurance? Yes. Is too big to fail bad? Yes. Should interest rates be controlled? No. You can go down the whole list. And then when you're done covering each and every separate kind of government intervention in money, and then you say, great, should government control money? Oh, of course. I'm not one of those nuts. And that I've seen a million times. Sorry, go ahead.
So in my reading of economic history, especially surrounding finance and money, there are lots of factual inaccuracies or pieces of information left out or misinterpretations. Do you think that that is coming about just because a lot of economists aren't very aware of banking history? They lack information? Do they have a political or professional axe to grind? What is the source of the lack of the complete story in academia and elsewhere?
I recently was toying with the idea of writing a blog post called Central Banking as a Cognitive Disorder. And the way I was going to write this post, I printed out the Wikipedia article on cognitive disorders, and it has this long list of these different disorders. And if you read that list, half of the things on the list are disorders to which, in my opinion, the scholarly community and lay people as well are subject to when they think about central banks and defend them. And the more I study this, the more I'm convinced that in order to understand the attitudes that are out there about central banking, you have to take these kinds of cognitive disorders into account. For example, an amazingly large proportion of PhD economists are paid by the Federal Reserve, either full-time or on a part-time basis. Well, a very common cognitive disorder consists of a natural tendency to not bite the hand that feeds you. That right there can explain a lot. But there are dozens of other disorders, the tendency to favor what's familiar against what's not familiar. Herbert Spencer wrote in one of his works around the middle of the 19th century, it was a work where he was defending private coinage, which of course very few people have ever done. He said, had the baking and distribution of bread been taken over by governments in ancient times, today the proposition that it might be better done by private enterprise would strike people as absurd. And he's right. And that is another cognitive disorder, that you can't wrap your head around with anything except what you know. And because most economists, with the exception of some economic historians, don't study the history of monetary institutions to any great extent, or study the institutional history in one country only, which isn't enough, because you have to be able to make comparisons. If you know everything about U.S. monetary history but have never heard of Canada having a banking system that was different, you aren't going to be as likely to recognize that the Fed wasn't the only possible solution to the instability of the 19th century, for example. And it's a rare economist who's exposed not only to the economic history of his own country, monetary or otherwise, but to that of other countries. In fact, they should all make a point of exposing themselves to those things in order to really know what they're talking about. I'm afraid I've got to stop. I've gone a little over, but thank you all very much for your attention.